And in our top business story, foreign direct investment in Abu Dhabi grew by 8.6% to 88.95 billion dirhams in 2015, compared with 81 billion dirhams in 2014, according to a foreign investment survey conducted by Abu Dhabi Statistics Center. The survey covered foreign direct investment for economic activity, the portfolio, and other investments. The Abu Dhabi Statistics Center said in a statement that the FDI rise is attributed to the increase in various economic activities. Investments in financial and insurance activities posted 13.338 million dirhams, accounting for 15.1% of the total foreign direct investments, compared with 12.731 million dirhams in 2014. 19.5% or 17.207 million dirhams of the foreign direct investments went to the manufacturing industries in 2015. Water, electricity, gas, and recycling jumped from 8.279 million dirhams in 2014 to 10.190 million dirhams in 2015, accounting for 11.6% of the overall FDI. Real estate activities, which include property sales for non-residents, reaped 23.793 million dirhams during 2015, while in 2014 it achieved 23.513 million dirhams. The survey also revealed that GCC investments represented 3.6% of the total FDI investments in Abu Dhabi. IPOs in the UAE markets raise more capital than they would in the US, according to a new study. The University of Wollongong study examined the pricing of IPOs on the Abu Dhabi Securities Exchange and Dubai financial market of stocks that would be too small to include in the Standard & Poor's 500, but would be large enough to be included in the ADX or DFM General Index. Researchers examined these against a comparable sample of stocks listed on U.S. markets, focusing on underpricing, a comparison of the issue price of stocks to their price on listing. They found underpricing was 19 to 30% lower in the UAE markets, which, according to the research, showed companies were able to raise more capital by listing in the UAE. The latest research rounds off a 3-year research program looking at IPO potential in various markets. The research investigated IPO performance in Australia, Hong Kong, Singapore, and the UAE markets, and in all cases, underpricing was lower in the smaller markets. JAFZA, Jebel Ali Free Zone, has announced a 15% growth in registered petroleum industry companies. Jebel Ali Free Zone, which is a part of DP World and the UAE's flagship trade and logistics hub, has revealed a growth in the number of petrochemicals, oil, and gas companies registered in the Free Zone, with the Free Zone attracting 112 new sector businesses last year, and the UAE continuing to support innovative enterprises and mega projects in the industry. Recent Free Zone initiatives, including the opening of new warehouses, office spaces at JAFZA 1, accommodation for workers, and ongoing sustainability projects, were considered the key factors for the growth in the number of registered petroleum companies. It was also revealed that while the petrochemicals industry in the GCC countries is mainly export-oriented, with 70.3 million tons of total production exported last year, products from the region, including plastics and fertilizers, are supplied to over 166 countries. Commenting on its growth, JAFZA officials were quoted as saying that the Free Zone will continue to cement its position as a key logistics hub, providing multi-modal connectivity to international markets with a dynamic and streamlined global supply chain, and supported by DP World's operations in 40 countries. Despite a recent dip in hotel occupancy levels and a fall in average room rates, senior representatives from Rotana Group announced that the market will stabilize in the next year as they celebrated their appointment as the operator of Cayan Cantara Project's hotel apartment. At a press briefing, Cayan Group, along with their partners, which included the contractors as well as Rotana Group, revealed the details of the new 1 billion dirhams Cantara project, which will be located on the Sukim Road. Planned to be developed by Q1 2019, the chairman of Cayan Group revealed that excavation work has been completed, and the construction on the two 38-story and 42-story towers will be soon. During the conference, they added that the project will include 700 units in the residential and hotel apartment tower, which will include studios, one-bed and two-bed apartments. Commenting on the expectations, panelists added that they're expecting an ROI of 8% per annum, as well as 90% occupancy rate when the project completes. As a result of supply growth, a recent industry report by STR suggested a 2% fall in occupancy levels, including a 10.3% ADR decrease to 767.58 dirhams and a 12% RevPAR decrease to 598.09 dirhams. Commenting on the climate, the developers said that hotel apartments are an important segment that can offer the flexibility to absorb the market fluctuations, adding that by the end of 2018 and beginning of 2019, they're expecting the market growth to be back on track.
Now Dubai is one of the fast-growing economy. It's just a stable, normal growing city with so much interesting news coming. The government is supporting the growth with their mega projects. So it is normal, steady for us at Cayan. We love working in such environment. It's a stable, steady growth every year. So we are comfortable, we believe in Dubai, and we will continue working in Dubai.
The RevPAR is being affected in Dubai mainly from a lower ADR, lower average room rate. Occupancies are still fairly robust. And if you compare the occupancies that we have in Dubai or in the UAE, but mainly Dubai, you'll find that in the world they're very highly placed. I mean, we're enjoying high occupancies, and it's only dipping slightly year on year. Why? Because there's so many reasons to come to Dubai still. So many attractions being built, so many exhibitions, and so many, the airline is increasing yearly. So, it's bringing so many more people into Dubai, which I think is what's allowing the hotel industry to survive, to tell you the truth. But because of this dip, hotels are going to have to adjust a little bit in terms of how they spend money, their cost base, whilst also driving their revenues. But I think the next couple of years will be very important to the region for us to settle down a little bit with the amount of inventory that we have coming in. You can't just take 10,000 hotel rooms a year and be like nothing's ever happened. There's obviously going to be a little bit of a tip. But as we reach 2019 and 2020, I think we would have reached more or less, I'd like to say, reaching nearly the maximum that Dubai can handle in terms of hotel rooms. So therefore, post that, we should start seeing a little bit of a, a plateauing out of RevPAR. So I'm optimistic.